So we're here at the Skyland studio, and we have with us today Dave Ramirez with Movement Mortgage. Thanks for dropping in, Dave.
Hey, thanks for having me, James. Always a pleasure.
So what's going on with interest rates? You know, interest rates are slowly rising. Can you shed some light to what to expect the rest of this year?
Absolutely. Great question, James. So ultimately, right now, the biggest thing impacting interest rates is inflation, right? So let's talk about that briefly here and how that's going to kind of shape the next couple of months or year, right? Looking back historically, when we've run into times of high inflation, let's think back to the late 70s, early 80s. I'm sure we remember that. You know, inflation went from, what was high single digits to the mid-teens, right? Almost overnight, really quickly. Ultimately, mortgage interest rates followed suit, going from at one point, say 12 to 18% in a very short amount of time. Pretty wild to think of those numbers. So basically, when we think about what the Fed can do to fight inflation, basically the lever that they can pull is increasing interest rates on short-term consumer credit, right? And so when we think of the Fed, increasing those rates, it's not long-term mortgage interest rates. Those sort of fluctuate based on some other factors. But what they impact is what's known as the federal funds rate, basically things that impact credit card rates, consumer auto loans, student loans, things of that nature, home equity lines of credit, right? So ultimately, that's the lever they can pull. And by doing so, when they start to raise those rates, that kind of slows down the economy and slows down and drives down inflation. It's seen as curbing inflation, right? And sure enough, that's exactly what would happen, right? So we look back at the late 70s, early 80s, when inflation was peaking out at, say, 14%, which is staggering, got down to 5%, a relatively short amount of time. Granted, that took close to 20% interest rates to make happen, but it did, right? So pretty fascinating there. So where does that kind of, fast forward a little bit into the 90s, we saw a very similar pattern happen again under Alan Greenspan. And ultimately, again, when inflation started to heat up, the Fed came in, increased rates, and sure enough, the inflation response was fast and effective, right? In the mid-90s, inflation was, pretty modest, 3.5%, dropped down to about 1% pretty quickly, pretty impressive. So mortgage interest rates followed suit accordingly, going from about the mid-8s to mid-5s, which was like a huge impact, right, in the industry. I'm sure you recall that. Yep. So anyway, so let's fast forward. So let's look at right now. What we're looking at is, we've got Chairman Powell in right now, nominated by Republican administration initially, reconfirmed by Democrats, so very non-political guy. And basically, when he walked into his job, inflation was sitting about 1.75%. Pretty calm, pretty mild for sure. And keep in mind, we've been running at this very mild inflation for a long, long time, to the point where it was actually below what the Fed's target rate of 2 to 3% was, right? You need a little inflation for a healthy economy. So anyways, over the course of his tenure, obviously we've had some big global events in the past 2 years.
Like the pandemic.
You got it. So inflation went up from that 1.75%. Now we're pushing 7% plus, right? It's too hot. It's starting to impact long-term mortgage interest rates, right? So that being said, what the Fed's looking to do this year is they're going to come in and they're going to start raising their short-term interest rates, short-term federal funds rate. That should have a pretty fast and direct impact on reducing long-term mortgage interest rates, right? Because that's seen as curbing inflation. Inflation is the arch enemy of long-term mortgage interest rates, right? So we want low inflation if we want low long-term rates, right? So that being said, inflation should come down, and mortgage interest rates should come down correspondingly with that. And what we're also looking at, which could be really interesting, is if there is any kind of slowdown in the economy, right? Stock market's pretty valued, pretty high right now. If there's any slowdown in the economy, one of the first levers that the Fed will pull, again, is to reduce rates even more. Quantitative easing, we've seen this, right? Yep. And so if you look back historically, every recession we've had since World War II, anytime the economy did dip, what happened? The Fed came in, reduced long-term mortgage interest rates again, and short-term rates, and that had an immediate and direct impact on the housing market. Real estate led us out of those recessions anytime they did happen, came out stronger, and there's never been a more affordable time to buy a home. When you look at where rates are right now versus where wages have been growing over the past several decades, the affordable index has never been better. And it's surprisingly, even with values where they are, it's never been a more affordable time to own a home. So
I love it.
Yeah, so that's hopefully that's what the tea leaves are showing.
So it's not all doom and gloom. So we appreciate you from the Sky Lounge studio, Dave Ramirez, Movement Mortgage. Thanks for dropping in.
Thanks, James.